but it looks like it went to YouTube. Whoa, guys, how's everybody today? Oops, if I get myself all set up with my background, there we go. Now we're cooking. Barbara, nice to see you again, although you're a silhouette tonight. It's all right, no worries. Warren, nice to see you, sir. Beth, Eva, cool. Herman, nice to see you again. And Mr. Smith, always. There you go. Now I can see you, Barb.
Evening, Ken.
What's happening, sir?
Not much. How you doing?
Pretty darn good. Mr. Zanolini, welcome. All right, we're just going to give another few seconds for some people to come in, and then we're going to get rolling. That's good with you all. Let me get myself organized here. It's amazing how many apps you can have open on one computer at one time. I remember when 2 apps would crash my computer.
Hi, Ken.
Who's that?
Yolanda.
Hey, Yolanda, how's it going?
Good. How are you?
I'm doing great. I'm doing
Good.
great.
Glad to be here.
I am I'm super excited for tonight's presentation.
Awesome.
I always wonder, boy, do I have enough content? And you know what? There's so many things going on. I don't have a content problem, that's for sure. All right. Many of you people, in fact, most of you have been here before. I can see, except for Mr. Zanolini. Were you here before? I can't recall. I think you were at one of my recent webinars, Jess? Thought so. Okay. Feel free to unmute yourself. I try to keep this very informal, so I don't even stop you from unmuting if you want to. So, all right, cool. All right, well, let's get rolling. I'm going to go right to our disclaimer here. So let me get to work, share my screen, because I got to do this part. It's unfortunately, it's what we got to do. All right. Let me minimize some people, make some way for my screen. All right. So I'm going to move my camera aside. Please note that investing in real estate and other financial instruments involves a high degree of risk and potential loss of some or all of your principal. This presentation is not an offer to buy or sell or a solicitation of an offer to buy or sell any interest, securities, or otherwise participate in any investment or trading strategy. Any such offer can only be made through definitive legal documents, including the operating agreement, private placement memorandum, and other important subscription documents, which include important information about the risk of loss and other risk factors. Finally, please note that nothing in this presentation should be interpreted as investment advice, tax advice, financial advice, or legal advice. Even though I'm a CPA, I'm no longer practicing, so you cannot rely on me anymore. Before making an investment decision, you should always consult your financial advisor. All right, so let's see here. Is there anybody? Sean, welcome. All right, I usually go through this exercise where I ask everybody to tell me where you're from and all that. Here's what's important to me. I want to make sure that you know how to get our attention. In the bottom ribbon across the bottom of your screen, there's a little button that says reactions, has a smiley face on it. Raise your hand, lower your hand. That's the easiest way for us to find you, because what happens is I get so many people on the screen, I lose you. I don't even know that you're wanting to talk. So you could even be waving your hand and there's a good chance I won't find you. So please do that. And please, let's make this as interactive as we can. All right. And feel free to turn on your cameras. You guys are a bunch of good looking people. I know most of you. So feel free to keep your cameras on. So I usually start this out by telling you my story, right? How I got into this business. I think just about everybody on this Zoom call knows that. My daughter's played a huge role. Well, actually, it's my kids and my family in total played a huge role in how I get into this business and why I got out of that CPA business. So I'm not going to do that again because you've probably heard it 76 times and it's probably getting old. So let's dive right in, because I got some really cool stuff I want to share with you tonight. So let me share my screen and let's get rolling here. All right. Pass the disclaimer. All right, let me clean up a little bit. All right. Since our last Real Deal Multifamily Index, some of you have been in other webinars, but you've not been in this one. Deal flow has increased like massively. We're probably working 20 deals right now. We're so busy underwriting deals. That doesn't mean we're going to be able to make deals. It means that their sellers are putting them out there for one reason or another. That is a really, really good sign for me, because it has been nothing short of a challenge. When you have 3 or 4 deals to underwrite, you're never going to find a deal. Secondly, rates are up about 60 basis points. Today, the 7-year Treasury traded at about 392. For those of you who have been coming to this webinar each month, you know that this interest rate thing, we have talked about it every single month. Every time I think it's going to settle out, it doesn't. It's currently at 392, 60 basis points up from where we were the last time we talked. To give you an idea of how impactful that is, excuse me, on a $10 million loan, that's $60,000 a year, $5,000 a month. That is enough to significantly change the cash flow in any small deal. The Fed continues to stay focused, very focused on inflation at 2%, and the labor market. They're really watching this labor market. The available jobs still outweigh the number of people looking for work. So that means there's, more people not wanting to work. Here's an important fact, as I listened to Powell's comments or read them yesterday, the prime working age group, so that's a 25 to 54 demographic, is seeing higher labor concentration. Now, of course, he doesn't explain what that means. I'm gonna surmise that might mean that people are feeling, I use the word poorer, that's probably a little stronger than it needs to be, but they need more income, so that there may be 2-person families, or remember the DINK comment, D-I-N-K, dual income, no kids. Maybe the second person is deciding to go back to work, not sure. But what is important, they think is important, is that there is higher participation in that labor group, because we need more people to come into the labor pool to help alleviate the growth in the wages, because that's what they're actually looking at. I showed you this chart last time. It's not been updated yet. I'm waiting on June. That should hit mid-July. So that trend, boy, why does my computer keep doing that? Sorry. My trend continues to be down, but we got to get as close to 2 as we can in order to make Mr. Powell happy. What's next? And do me a favor, if you have questions, put them in the chat, raise your hand. Don't forget to do that. Max is with me. He's going to help me manage that, because in order for me to do this, I got to close up my chat and I don't get to see if you're trying to talk to me. Markets think, and I think the Fed is signaling that there's probably another 50 basis points rise before the end of the year. What does that mean? That's a 0.5%. Some people, excuse me, most people think it's going to happen at 225 basis point sessions. We don't know, but interest rates seem to have settled out in that 380 to 390. I like to watch the 7-year. And it seems to be settling out right there, which sort of supports what I think the market is trying to tell us. Here's what's interesting. I think there were a lot of sellers who were waiting for rates to come down. I think, if you're having a debt problem right now, people were really hoping that inflation would go down quickly, the Fed's interest rate hikes would have a dramatic effect, and the Fed would be compelled to start lowering rates. I think there were a lot of sellers with debt problems that were hoping that would happen. I think they might just start capitulating and decide to sell to solve their debt problems. I don't have any proof of that. It's just the deal volume seems to be going up considerably. And I don't have a really good explanation other than that. But it seems reasonable to at least consider that might be what's happening right now. I will tell you that as buyers, we have to be persistent, and we are, write as many offers as we can. Some of these people that are bringing stuff to market, they're just fishing, trying to figure out what they can get. Some of them are real market sellers, and they want to sell. So it's, the brokers are really going to try to hide whether or not somebody's fishing, because they want to make a deal. So discipline and patience right now are critical. I always have that patience discussion with everybody. But we submitted an offer last night on a deal, and we will likely be hopefully submitting another one by the end of the week, or maybe early next week. on a deal. All right. Let's keep rolling here. All right. I am still watching the office market. If you have been on some of my recent meetings, you know that I'm concerned about the office market for obvious reasons. People are working from home. As these leases roll, I think people are going to downsize the office space requirements. I do think it's gonna impact the banking world. This is not new from what I said last time. I think the losses are going to be real, but I don't think it's going to create a financial meltdown. I think it'll impact the regional banks more than anybody else. So we'll have to see how that happens. I do know that the Fed seems to be keenly aware of this potential problem, and the fact that they are guaranteeing deposits pretty much to infinity. Is really making, they're doing what they can to make sure that there's not a run in any more regional banks. I have less visibility or less confidence in what I think is going to happen next right now. I feel like sometimes the market wants to go up, but the Fed is so focused on beating down demand. It's kind of like everything is just kind of wandering around. This uncertainty, when I talk to brokers and I talk to other clients and apartment owners, it's just kind of wearing them down, right? They would really love to understand the direction, and it's just the fact that we just kind of meander. Sometimes we're up, sometimes we're down, sometimes we're going to raise rates, sometimes we're not. I mean, it's kind of exhausting to them is what I think is going on. We did talk about 4 things, as I sent out the email, that I do want to talk about tonight. So let's get on to that. Okay, the first is the continued rise in interest rates. I do think this is going to prove to be the most problematic issue for most investors or sponsors. I just think it will, because it's a really big challenge to deal with. And I'm going to show you some things tonight that I hope will help you illustrate the impact that this is going to have on folks. Again, I said a lot of these people are hoping rates will turn lower, letting them refinance or sell to solve their debt problems. I just don't know that that's going to happen tonight. If you were to ask me if I thought rates are going to come down anytime soon, I would say no way. But maybe a month ago, it might have been different. I think those people are losing hope. I think I mentioned that. We are working tirelessly on our fund to try to make sure that we are ready to go, right? In order for us to get a deal, we have to be ready to go. The moment we see something we like, we got to be ready to submit, basically pounce on it, because there are a number of there's people out there looking for deals right now, and we're going to try to leverage our relationships and our strength as a fund as opposed to a syndicator. And we're hopeful that will get us to get a seller potentially to preempt a deal and to consider our offers without going through the full marketing process. I know that I've talked to a lot of people. I have a feeling that some people are out there kind of hanging around the rim, kind of trying to figure out whether or not they want to invest, just because, I just know that they're doing that. Here's what I would say to you. If you are one of those people that's hanging around the rim waiting to see, hey, I know I want in the fund, but I don't know how much, and I don't want to make the commitment until I know they have a deal, do me a favor. I need you to reach out to us so that we have a better feel for what's in that pipeline, so to speak, right? I call them soft commitments. We don't count on soft commitments, but it is useful to know. I will tell you that when we get a deal, it's going to happen very quickly. So please, if you're going to use that strategy, and I would want you to commit instead of just hanging out waiting to see if we're going to get a deal. You're going to run the risk that it's going to happen so fast that you're not going to be able to get in. And, it might be you miss one email and it could be the difference. So just please, if you're going to hang around the rim, hang really, really close. But I would take the more obvious route and just make the commitment, right? All right. Next, why are some of these markets softening and some of these are not? I get this question a lot. I will tell you that some of the markets out there are seeing massive new supply. I know Warren is on this call. He lives in Phoenix. We talked about this last time. Massive new supply of apartment units. They're all hitting at the same time. It is not a new phenomenon. The builders temporarily, I say destroy markets. That's probably a little strong, but it kind of does. It destroys the rental market until that new supply is absorbed. And it's because builders have different objectives than operators do. Builders want those units leased up. and they will heavily discount if that's what it takes to get it done, because then they get their draws, they get to continue and finish the project, and that's how they make money. So usually it's a temporary problem unless the overbuilding is so severe that it takes years for an MSA to grow into the new supply. So there's probably a couple markets out there that's happening, but that's why some of these markets are soft and some are not. It doesn't really affect us too much. I purposely tend to stay away from the A class, because the A class assets, the really newer, really super nice stuff, is the class that gets hurt the most when builders come and overbuild like they always do. It could also, this is an interesting, and this is sort of an indirect effect, but when you have all this new supply, even though it's a product, even though it's, $3,000 a month in rent, $4,000 a month in rent, it's heavily amenitized, it can make somebody who is facing a debt problem, facing a rate cap maturity, or an increasing variable rate loan, it can really hurt them, because in a soft market, they know they need to stay as full as they can for cash flow purposes. And that means they need to start discounting to make sure that they stay full. So now when you sell and you look at the trend on their rent roll, you can see that their rents are starting to taper off, that they're starting to get soft, that they're starting to go down a little bit. And that's really just another challenge for somebody trying to sell right now, if you're in that environment, because when the agencies look at that situation, they are careful, because they don't know how much softness is going to be in that market. They might have a clue, but it's going to make it more difficult for somebody getting a loan when they're buying your asset. And the buyers are going to underwrite that deal a little bit differently if they see new leases coming in lower than leases previously. So I think there's a lot to unpack there. I wouldn't get too worried about it, because usually this overbuilding thing is a temporary thing. When I say temporary, I'm talking about a year or two, just depending on how much overbuilding is going on at the same time. The next thing is, I want to talk about why details matter more than ever. And this is where I'm going to get into some interesting stuff. Hopefully you find it as interesting as I do. You really have to be super disciplined right now and underwrite your deals properly. You got to pay attention to all these details. So what I'm going to do is I'm going to stop sharing this screen. I'm going to pull up another screen. Max, do we have any questions while I'm doing that?
No, I don't see any in the
Okay.
chat to the group. No.
All right, cool. All right, so let me share this screen, because this, I call this webinar the real deal. Well, this is about as real as it gets, man. This is a report out of our system, directly out of our system. This is one of our properties. This property is called The Crossing at 2600. It is, usually you see this report as a T12. I ran a T20, excuse me, because my system will allow me to do that. And this, I think this is really important. So in this deal, I want to show you the historical, how we've made money on this deal, how we'll continue to make money, but I want you to see it in terms of the real rent. So when we bought this property, it was right here in November of 21. I think we bought it right at the end of October. So we'll call November the first month. Our average rent was about $894, and our gross income, if we were to have every unit full at the leases that were in place, we get about $75,000. So then you just follow. Okay, so we took over. We're probably on a 60-day notice. Rents are pretty stable. And then all of a sudden, whoop, you see, we start to move up. We start to move up because when we come in, we look 90 days out and start offering those people renewals and increases, because we knew this property was under market. So now you can see, I'll do this very slowly, but if you watch the trend, the income and the average unit lease, just look at how it slowly grows. Sometimes it grows quite a bit, like from here to here, man, that's a pretty big number. That's a big jump there. Just, and the speed at which this happens, and you see this uneven growth here, 1,000 to 1072, that just happens to be what leases happen to be maturing in that particular month. So if we turn more leases, we move rents a lot faster. So you can see here what's happening. We're into September of last year, October. You can just see a slow trend. So here's what's important. We have increased rents on this particular property, the average rent in that property, $321. This is 84 units. So from November of 21 to June of 23, that's less than 2 years, we're up $321. Now, the next thing, and these are all part of our P&L. I'm not going to go over all these little details. What I've tried to do is highlight the ones that I want you to pay attention to. Another interesting fact about this property, look at the water bills or the water income. There was none. When we did our rent survey and we did all of our work to underwrite the deal, we noticed everybody in the market is passing through water, but not this guy, right? It defies logic as to why he didn't want to do it, but he didn't. So what you saw is we did the exact same thing. We took over here. We looked 90 days out, said, okay, guys, your leases are renewing. Yes, we're going to raise your rents, right? You saw us raise their rents here, but we're also going to implement a RUBS system. A RUBS is a ratio utility billing service or system, and it basically is going to bill back all the water. So now you're going to see a very similar thing happen here. You're going to see this thing trend up slowly. Actually, it's quite rapid. And then you'll see we're at about $5,400. So this water went from 0 to $5,400. That's huge. So when we look at the total income of the property, you're going to see it went from 74 and change. Let's use round numbers here. It went to 104 and change. That's $30,000, more than $30,000 a month in revenue. Multiply that times 12. It gives us we'll call it $368,000 in new cash flow. Now, here's the thing that I want to point out. I'm going to share a different spreadsheet with you now. I don't know if, let's see how this, Max, tell me if you can see my rent comps. Can you?
I cannot see your rent comps, no.
All right, let me unshare and reshare. Sorry about that, guys. But this is, first of all, is everybody with me on what's happening here? What I'm trying to do is illustrate when we bought this property, what has happened to income. And now I'm going to show you what we did up front to underwrite this thing, right? I said it's very important that you underwrite properly. This is what we do. This world, in our world, this is all about it's all about income. So what we do is we do something called a rent survey, and it's super detailed. I'm not going to go through all the details. This is going to be very visual. See these light blue properties? These are generally properties within a mile of this property. The yellow line, that's the property where it was when we bought it. Now remember, this analysis was done before we bought it. So before we bought it, the 1 bedrooms were at $897. We thought, based on looking at this survey and the properties around it, we should be able to take ones to $1,100. I mean, so when you look at this, is it believable that we should be able to move rents, move it up 2 places in the rent stack? We still have a lot of air above us, right? We still have a lot of upward possibility here, right? This is how we analyze rents, right? I'm giving you the real deal. This is exactly what Max and I do every single day when we're underwriting. We did the same thing for our 2-bedroom units. Same competition, same concept. Here's where it was. Our 2 bedrooms were at $1,000. We thought they could go to $1,300. And guess what? It looks like we should have no trouble taking it to $1,300. Now, there's a lot of work that goes into this, but here's what's important. When you look at this as an investor, I mean, without drilling down, it looks at least reasonable to think that we can move rents a little bit. We're at the bottom of this whole rent stack, and we still have the whole thing to go. We should not have too much trouble. Did the same exact thing with a 3-bedroom unit. Now, this is fair to say pretty detailed stuff, right? Does everybody agree with that? Any questions on what we did there? Because I'm going to relate this to what we actually have done over the last 3 months. So now over the last 3 months, let me get the right spreadsheet back here. Stand by, guys. Over the last 3 months, you have heard me talk about the strategy that I was putting in place to try to deal with these crazy interest rate environment, right? This particular property had a bridge loan on it because we had some work that we wanted to do to it so that we could get our $30,000, our $368,000 worth of rents, new income. So we put a 3-year rate cap there to protect us against rate increases. So about 12 months in, and then when I started to see volatility in interest rates, I said, and many of you know this because you were on these calls previously when I talked about this. I said, what drives me nuts is every single time rates go down, I say, okay, let's get rolling. Let's refinance. Let's take this bridge loan out. And I start the application process. Then I order the appraisal and the environmental and the property condition report. And by the time all that stuff comes in, guess what happened? Rates went up. And now I'm mad because now everything's totally different. So what we did, and I did this because I told you I was going to do it. We went out and we said, all right, Mr. Lender, we want you to get all your third-party reports done, do all of your credit underwriting, and put it on the shelf. And we're just going to sit here and we're going to hang out and we're going to stalk these interest rates and we're going to wait until the time is right. And then I'm going to pick up the phone because we have all the approvals done and we're going to strike. Well, because we were able to do that, that strategy paid off. You saw me do it live, right? So now what I'm trying to show you is how detailed this business can be. We were able to refinance that loan. It was at we'll call it 7.5 million. We're able to put a new loan at 8.25 million on it. So we got more money. It's a higher loan, right? There's some costs there. I didn't break them out because I don't want to get too detailed. Our old payment was 37,750. Our new payment is 36,300. So we got a decrease in our payment. We got more money on our loan. And we were able to sell that rate cap because we didn't use it all for 3 years. We only used about a year and maybe a couple months of it that we paid $39,000 for. We were able to sell it for $266,000. Now, why were we able to do that, right? So now we're rate protected out for 5 years. We are good to go. Anybody can put a supplemental loan on top of it if we want to sell it. We're super safe. We're very well protected. Our rate was 5.28. Our rate cap was actually protecting us till just under 6. That's why the loan payment went down. So, so now why was this possible? Why were we able to, even though rates went way up, even though cap rates went up, why were we able to refinance at a 65% loan to value, put a new loan on, get some money out, and do all of this? It was because of this right here, because we were able to generate massive new cash flow. So where I'm going with this is, remember the rent survey we talked about? Remember how important I always say it is to make sure you do the homework and make sure you understand rents. Because we did that, we were able to generate, and we're still generating, we're going to continue to raise rent at this property. We generated $367,000 worth of new income that we could use to protect ourselves, maybe refinance it. And let me show you one more thing. First of all, is anybody lost? Are we cool? Max, are we cool?
Yeah, we're cool.
We're cool? All right. Let me show you what would have happened if somebody didn't do their homework, somebody didn't take the time to do a rent survey, someone didn't really dive in and do the details and do a really good job of underwriting. Here's what would have happened. Now, this is an example of what our debt did during that time. Remember, guys, this is a real deal. Nobody's going to share this kind of stuff with you, but I want to share it with you so you understand how important this stuff is. So this line right here, this row is our debt. We made our interest payment on our note, right? You can see we're still November, December, January, February, March. Look what happens here. So you can see that every month, here we go. Now rates started to go up on us in August of 22, September, October, November. Look at that thing. Look at that interest payment. It went from 26,000 up to 54,000. Like, that's like a double. That's a double on your interest expense, right? Well, what do you think happens if you don't have any new income to support that? You're toast. Agreed? Your investors aren't going to get any money. You might even have to go to them to support the property, and you're going to have a lot of problems. Fair? Is that a fair statement? Now, let me show you how a rate cap works. We had that rate cap in place because we wanted to be protected out for at least 3 years, and we could have bought another rate cap, but we didn't need to. Notice how the rate cap did not pay. It's still not paying. It's not paying. It didn't pay until September. So what happens with the rate cap is when the rates get up to the point where they're protecting you, they actually write you a check to make up for it. That's why you see negative numbers here. So in that month, they wrote us a check for $2,000, then $5,000, then $7,000. 7,400, 11,600, 14,300, 13, 16,500. They wrote us checks to protect us so that our interest expense would stay flat. That's why the lenders require it, because they're concerned they don't want interest rates to go up so fast that the property can't afford the new debt or the new interest. Does that make sense? So the gross note payment, right, between the 54,000 to the 26 was a $28,000 increase. If we had not, first of all, if we had no protection in place, that 30,000 in new income would have gone directly to the lender, right? Does that make sense? Because the interest rates went up. But because we had protection, our interest expense did not go up. And because we got so much more income to the property, we were able to refinance, get rid of that, and fix our rate at a lower percentage. That was a lot of stuff. Does anybody have questions? Because I'm going to show you how we or what we use to do all of this. Is everybody cool? There's got to be somebody with a question. I mean, there's so much packed in there.
Yes, I have a question.
Who's talking? I can't figure it out.
This is Dr. Holt.
Oh, hi, Dr. Holt.
Yes, thanks, Ken.
Oh, there you are. I see you. Okay, sorry. Hold on. Let me spotlight you. It's
Yeah.
Sorry about that.
Thank you. My question is, how do you know how much rate cap to get?
Yeah, the lenders usually tell you. So what happens is the lenders do their own version of underwriting, and they say, okay, how much debt, how much interest expense increase can this property sustain? And then they determine that, and they say, okay, you got to go buy a rate cap, and it has to protect you to a certain point. So they figure that out for you.
Okay.
I could have figured it out myself, but usually, I mean, the lender's going to require that rate cap. So we let them figure it out. Does that make sense? Yeah, that's a really good question. Any other questions? None? Nobody? It's too much? TMI? I hope not. All right, so let's keep rolling.
Hold on, sorry, Ken, we have one more question.
Of course.
Just came up in the chat. Barbara asks, how do I learn more about the rate cap and when they pay you back?
Yeah, so how do you learn more about the rate cap? Well, I suspect if you want an education on rate caps, on a lot of this is technically a financial derivative. Chatham Financial, if you go to their website, they have a lot of really good information about rate caps, about interest rate swaps, all that kind of stuff that really helps you understand. So I would recommend that you go there. Now, I will tell you that a rate cap is nothing more than an insurance policy. That it says, hey, Barbara, if you buy a rate cap, and let's say your loan is based on SOFR, or let's say it's based on the 5-year treasury, the 1 month treasury, right? So it's going to bounce up and down, right? You will say, Ken, I want a rate cap that makes it so that if the treasury goes over 3%, you will protect me. And if my lender charges me 6, 7, 8%, you'll pay the difference. And I say, okay. And then I go do my magic, my financial magic. I don't know how they do that. That's a little above my pay grade. But they figure out what are the chances of that happening. And they use something called forward rates and all kinds of crazy math. And they say, all right, I say, Barbara, I'm going to charge you, in my case, Barbara, I'm going to charge you $39,000. And for the low price of $39,000, I will give you 3-year protection against rates going up. That's what happened to us in Crossing at 2,600. And I remember doing that deal, and the 2-year was 30,000, and the 3rd year was an extra 10. And I remember they said, well, what do you want to do? You can always buy it later. And I thought to myself, because my experience with 08 and 09 and all kinds of, funky debt issues, I said, wait a minute, I don't want to be in the interest rate speculation game. I want as much protection as I can. It's only 10 grand. I know that sounds ridiculous, but on a $7.5 million loan, it's not a lot of money. So I said, I'm going for the 3 years. Let's do it. Let's lock it in. And of course, it turned out to be the right decision, because I just want to show you how just crazy these rate caps turned out to be to save a lot of people.
Could you have done 5 years?
Pardon me?
Could you have done 5 years? Like, can it go on for as long as you wanted?
I probably could have. That's a good question. That's a really good question. I've never tried to buy a 5-year rate cap. I suspect you can. It's just going to start getting expensive
Okay.
even more because they're going to even have less information to make that pricing decision, right? Because now you're really talking out into the future. And remember, when I bought this deal, everybody everywhere is like, oh, they're not going to raise rates. There's no way they can't raise rates. That was what everybody was thinking. That's what the market thought. Well, guess what? The market was wrong. But the lenders know they want to be protected. And so let me just show you what's interesting. Remember, I paid $39,000 for that rate cap. After I paid off that loan, that bridge loan, the next day I went to Chatham and I sold them that. I cleaned out of that rate cap. I said, I don't want the rate cap anymore. I don't need it. They valued it at $266,000. So they literally sent me a check for $266,000. Now, here's what's even more crazy. You see all these negative numbers? These are all payments by the person that wrote the rate cap. Let me just do quick math for you here so that we can just, it's just ridiculous. They paid out $78,000 plus $266,000. Think about how much money that is. That is $344,000. I guess I 10x'd it, right? I 10x that money. Now, that's a good thing. That's icing on the cake. That is not why I bought the property, but it is because we were able to add so much cash flow to this property because we did our homework, because we made sure we knew what rent should be, because we were so convinced that our plan was the right one. We were able to raise that monthly cash flow. That gave us that flexibility to refinance. We could have probably sold, but I don't want to, it's too early. I don't want to sell in a 6+ cap rate environment there not for this property. I just didn't want to do that. So we're going to stick it out. This property is going to continue to cash flow. So really good question. All right. Any others?
Yeah, we have one more in the chat from Karen. She asks, do you recommend purchasing the 6% cap rate or for how long in this market?
Yeah. So here's what I will tell you. Whenever I don't want you to be in the interest rate speculation game. Look how wrong the market got it. They sold me that rate cap for $39,000. They're supposed to be really smart people. They took a bath. They got clobbered on it, right? So if they're they're light years smarter than I am. If they can't figure it out, there is zero chance I'm going to figure it out. There's probably below zero chance. So given that, I want to make sure that I fix as much as I can. So you can do it with rate caps. You can do it with just straight fixed rate loan. Like this loan that we have now on this property is a Fannie fixed rate loan, 5 years, 5.28 interest only. I'm done. It's done. I am safe for 5 years and I don't need to worry about it anymore, right? Because Fannie went out and funded it their own way and set their margins and everything else. So you're going to want to protect yourself somehow, whether you use a rate cap, whether you use something else to do that, it doesn't matter to me. I just want you to be protected, right? Because so now here we are sitting at, a 7-year treasury that's 3.92. And we think, oh, how much higher could it go? Right. You could easily talk yourself into that. And then you could be dead wrong again. Don't do it. Protect yourself no matter what. And who should you seek advice from to do that? Your lender. Chatham. Those people at Chatham are pretty smart people. But your lender is going to really require that you do this. You can also use something called an interest rate swap. I don't want to get into that. That's really even more technical. But it's what it is. It's a hedge. Both of these things are hedging instruments so that you can do what you do. Like I do real estate. I don't do interest rates. I do real estate. It allows me to do my thing and know that I have a fixed number there that I can live with. All right. Are we cool with that?
Yes.
All right. Let's get back to business here. Let's keep moving. All right. So, all right. This is the property that we have just been talking about. This is crossing at 2600. Many of you have seen this picture before on previous webinars. A couple more pictures. This is the back of the clubhouse. You were looking at the front before. This is the back. The swimming pool, look how well shaded it is. People love shade in Florida. They just do. And I mean, it's just a cool looking property. This is probably one of the only tennis courts in Florida that gets used every single day. And it's because these trees have been trimmed back, by the way, since then, since this picture was taken. But see how heavily shaded this tennis court is? Because of that, the tenants just absolutely love it. This is just more pictures of this particular property. It's a cool property in a nice wooded area in Tallahassee, and a little exercise room that we have there. Now, here's what I would, there is something, I'm going to mention this briefly. This is not the purpose of this call tonight, but I do want to share with you. I am proud to tell you that we did just roll out our underwriting course. I just want you to know about it. I'm not here to sell you the course. What I'm here to, what is important to me is that we have watched people struggle in this business, because as you can see, it can get kind of complicated. And I feel very strongly that if I can educate people to do this the right way, a lot of investors will stop losing money who are investing with people that just don't really understand all the real details. So that's the reason I put this course together. It's out right now. If you got it, you get I'm going to teach you all the detailed stuff that I just went over and a whole lot more. You get our quick reference guides, our deal screener. So we have developed a deal screener. Remember, I said we're running through 20 or so deals right now. See, we only have 2 or 3 deals. You can take the time to underwrite them fully. When you got a whole bunch of deals at once, you got to have a fast and easy way to do it. This is our deal screener that we use every day. You get that spreadsheet. Our rent stack template is the same. It's very similar to what I just showed you. Whoops, my computer needs to stop doing that. And then our full underwriting spreadsheets in the course. It's worth a whole lot. We're only charging $9.97. Now, I did add something to this. I did this just yesterday because the thought occurred to me, this is complicated stuff. I want to be there for anybody that's in this course every week to make sure that you have every question answered. Some of the people on this call have been on calls with me every week. So hopefully those calls have been helpful. And if you're in this course, you get those. So again, I only bring this up because there are a lot of people on this course trying to figure out this on this call that are trying to figure this game out. They're trying to understand how to underwrite. I'm telling you, it's all about the details, as you can see. So if you are one of those people, you should check this out. And if you're not, totally fine with me. All right, let's get back to, the whole purpose that we're here, right? So the last question in the topic, should you invest now? I'm going to ask this every single month. I just believe you should invest in any market. Just follow disciplined underwriting and vetting rules, and you'll be fine. There is no change to what I said last month, so I'm not going to go through this thing in detail, other than to say, I still think we're going to get some cap rate compression over the next 5 years, which will be helpful. And I do think we'll get some insurance relief over the next few years, which I think will be helpful. And let me tell you why I think that in the coming slides. So on the ground, we have, I just picked 4 properties: Arbors at Garden Grove, 96.7, our Palms at Daytona, 94.5. Crossing that you saw is 98.8% occupied, or leased, I should say. And Landings at Crystal Cove, a big property, 91.5. If those of you have been around me much, I hyper focus on occupancy because we're in the cash flow business. And if you don't have people in the units, they're not going to give you any cash. So I tend to focus on occupancy, even if it means I have to reduce rents a little bit to make sure I get there. I will do that because that's more important. In general, the Daytona market right now of all the markets is probably a little bit softer, and it's just because it's a relatively small market and it is getting some new supply right now. So even though it's not a massive amount of new supply, it is being a little bit affected. Tallahassee is a little bit soft, but for a different reason. There is one property near this property that, I don't know, they've been struggling forever. I just think it's poorly run. When we do our rent surveys, which we do every single week, by the way, what's happening is we watch this one property kind of pulls the whole market down because they're trying to figure out how to fill up. And if we just stay close to them, we are fine because we're not poorly run. But that's the deal in Tallahassee. I'm very comfortable in Tallahassee still. Delinquencies in general continue to be low. That's important, right? When you see delinquency spike, that means that people are starting to struggle. Mr. Powell is trying to make people struggle, right? That's his job. That's his only way he can affect demand is by hurting employment. That's what he has to do. It's not a personal thing. He just has no other way to affect demand. And so as the unemployment rate starts to increase, we may see delinquencies trend up a little bit. We'll see. We stay right on top of delinquencies really, really strongly. So I don't think we'll have a huge impact. Plus, it helps that we're in markets like Florida, that if somebody doesn't pay their rent, we can throw them out. The government doesn't stop us from doing that. And there's more people to take their place. So I don't expect that we'll have much delinquency problem. We don't have a lot of retracement yet. Still, a lot of these comments are very similar to what I talked about last month. Our leasing traffic, I just looked this as of yesterday. We had 359 leads so far for people who wanted to move into our properties, a lot more than what we have vacancies. I can guarantee you that. So those are metrics that I look at. Some of the numbers might not be meaningful to you. I'll tell you if they're trending in one direction or the other. When I look at our average rents, I care about what's happening with new leases and what's happening with our renewals. Now, in the last month, or no, this is this month so far, our new leases. So somebody moves out, somebody new moves in. This is across the portfolio. They're up 18%. And on renewals, they're up 19%. That's a little weird. You don't usually see that. It's probably just because coincidentally, some of the leases, some of the people that moved out were probably closer to market rent. That's most likely why that new lease number isn't higher. We do not offer any concessions anywhere. In the properties we own, we do have a couple of properties that we're turning around that we do not own. They're third-party clients that we have a little bit of concessions in place, but we do not. On the insurance front, this is really important information if you're trying to understand how to underwrite deals. We got a 6-month property extension on our Bradenton deal with no increase. That was huge for us. I was just thrilled. We did get a 19% increase in Daytona. I mean, it's to be expected. The property's within 5 miles of the coast. That's where they get stressed out. But those are townhomes. Those properties will be just fine. Our GL is general liability in Winter Haven. That's our Arbors of Garden Grove deal. This just blew me away. It went from 19.3 down to 9,800. Nobody is seeing those kind of decreases in GL. They're just not. And I'd like to say we're just such incredible operators that they just love us and they want to say, I don't know. I don't have a good explanation. I think it's probably a combination of that. Our properties are clean. We rarely have claims, and our insurance guy just worked really hard to take care of us. Similarly in Bradenton, that's a very big property. You can see the GL was almost $91,000. We went down to 61. I mean, that's huge, a huge relief. So when I say that now, most people are not hearing these stories. Okay. Most people are seeing lots of increases for various reasons, right? Maybe they've had claims or what have you. We really try very hard to manage that insurance relationship very carefully because as you can see, it's a really big number. Debt, I've been talking about debt nonstop. All of our properties that we own, we're good for at least the next 4 years. We're hanging around the rim here with that same game plan on Arbors at Garden Grove. We couldn't get everything done quite in time. I couldn't lock it in at the same time I did Crossing. I was a little frustrated by that, but it is what it is. We're just waiting for rates to go back down. And if they don't, I mean, that property there's plenty of equity there. It's cash flowing. We're going to sit tight and leave the third-party report sitting on the shelf, waiting for rates to get to a point where we can, we like them. When we do that, our investors will get the rest of their money back, probably another $1.5 million, and the thing will still continue to cash flow like crazy because we've increased income so much in that property. I will tell you, now's the time to, this is our position. We're working really hard, working overtime to try to get our fund fully committed. And we have enough to close a deal, but we want to maximize the amount of commitments we have right now, because when I go to brokers and when I go to sellers, our commitments, the fact that we raised the money already matters huge. In that last fund, fund number 1, we did $16.5 million. You already know what happened in Tallahassee. You've seen, I laid that story out pretty well. The Bradenton deal, I think the last time we reported, it was about $181 a month in increased rent. It's up to $230. I know that seems crazy, but we've renewed a lot of leases and moved in a lot of people. So massive new cash flow there. Think about 230 times 234 units. That's a lot of new cash flow. 55 units in Daytona, that's a townhome property. It's also doing very, very well, up $238 a unit. And both of these two deals at the bottom, we bought them about a year now, about a year ago, almost exactly a year ago. So I'm not disappointed with the performance for sure. The fund that we're raising, most of you know this already, some of you may not. Our target overall returns 15% annually. Some of that is from your preferred return. Most of it's from when we sell the property. Basically, in our fund, you get your capital back, you get your preferred return, and then we split the money 80-20. You get 80, I get 20. That's how it goes. Try to keep it super simple. You get a right of first refusal on all your side raises. Many of you that were in the Bradenton side raise was able to invest more money in that deal because you had that right of first refusal and you took almost all of it, I will tell you. So I was certainly excited about that. Our minimum is 100. Accredited investors only. We try to hold our deals 3 to 5 years. Remember, I can hold it longer if I need to because I don't want to sell with a gun to my head, but our target is 3 to 5 years. And when you look at our track record, you know, we try to hold true to that. And that we're sticking to the Southeast and Southwest. I think you all know by now what to do. Reach out to me, reach out to Max, click on the QR code. By the way, if you do click on that QR code, it will take you to our information page that has testimonials and the webinar and our full track record and all the legal docs. Everything you need is right there. I try to put it all in one place. Remember, our marketers did it, so there's a little bit of fluff there that I sometimes get stressed out about because, you know, they're marketing people and I'm a CPA, so you can imagine the battles we wage here with those guys. So, all right, Don, I see. How am I choosing exit caps when you model deals? That's a great question. Right now we're looking, so when we go in, we're looking for even leverage. So if rates are at 5.9, right? If we're at 3.9, 3.8 plus 200 basis points, we're at 5.8, 5.9. That's what we're going in at, and we're adding about half a point, half a percent to that. So we're going up to, if we're going in at 6, we're going to 6.5. That's generally what we're doing. You could make an argument for more, but at some point it just becomes ridiculous. You could, I mean, you're just never gonna, the deal's never gonna work. It won't. I will tell you that there's not a human being on the planet that modeled the increase in cap rates that we have experienced over the last 2 years. Yeah, Donna, you're welcome to unmute yourself, Donna. I can tell I'm sure you have some good comments.
I just
there you
really
go.
I really enjoy these meetings because I feel like you have a great combination. You have like you just have a modeling powerhouse and an operational powerhouse, like in one sponsor. And it's hard to find that always, like someone's looking, and I just really enjoy the way you think about things. I feel like we've always all taken that interest rate risk, but none of us really focused on it before. So theoretically, I guess, you know, rates, something crazy could happen in the late 20s, right? And the rates spike to 8, which will be out of the money, but you can't, that's just the nature of the business. So I just wanted to kind of know how you were looking at it, just to see what the framework was.
Yeah. So that exit cap rate is projecting out 5 years. I just want to go into a little detail because I think you like to know how we make the sausage here.
It's really your judgment. That's the more, like, any of the details. You guys would know that stuff way better than any of us, but I just love hearing how you think about things. It's helpful.
Yeah, well, good. And I'm thrilled to share them. So a lot of the way I managed that came from my 5 years as a commercial lender. And I spent some time in workout. If you know anything about banks, when they get tired of you, they send you off to the workout department. And it's not fun. I spent a year there. I know what it looks like. It's not pretty. So I had a lot of that experience. But even more importantly, I went through 08, 09.
I'm with you. I still have PTSD from the experience. I don't mean to make light of that at all, but
yeah, no, it was brutal. I mean, I I watch that every single day. I'm telling you, if you ever have the opportunity to watch the movie, it's a documentary. It's a cerebral one. Too Big to Fail. It is a
That's the
documentary.
long-term capital management stuff? Is
Well,
that-
no, it was a book that was written by Andrew Ross Sorkin. If you watch the NBC, he's one of
Okay.
their morning hosts, young guy. He looks like a kid. He's such a baby face, but he wrote a book. It was like 2 inches thick. Well, there's zero chance I have time to read a 2-inch thick book.
Yeah.
So they came out with a documentary on that book. And I've watched it so many times. It is the most accurate depiction of that whole environment, that if you want to go, it'll probably bring you back to your PTSD. But the things that the government did then literally saved the financial system. They did. I mean, I could not imagine being Hank Paulson through that situation. I mean, I don't know how he didn't have a nervous breakdown. I mean, to think the weight was on his shoulders was just incredible. But here's what I learned during that time. I learned during that time that you got to be careful about how you present things in your P&L, because you never know when the lender's going to turn on you. It used to be before then, your tax books looked very different from your books, right? You were expensing everything on the tax return, but not on books. You would capitalize those things, and that's okay. Except the regulator said you got to use the guy's tax return, and that's what you need to use. Well, that screwed everybody, because everybody was expensing everything. Everybody busted all their loan covenants. So now why did they do that? Because they wanted all this real estate off these banks'
They
books.
wanted control of the situation so they can get rid of everybody, right?
Well, they wanted real estate off of the bank's books, because remember, real estate was toxic then. So
Okay.
now all these people had to go out and find new loans. But guess what? There was no one there to give them a new loan.
No
You
liquidity.
literally couldn't get a new loan.
Wow.
They closed their doors, said, nope, don't come here. We're not lending you any money. Everybody was trying to get it off their books. So what that taught me was, man, don't ever say never, right? Because that was pretty extreme. So what I do when I manage my debt is I'm balancing a number of things. One, I'm trying to protect myself and fix that expense so that it's not wild, okay? And fix it out for a period of time. Whether I use a rate cap, an interest rate swap, whether I use a fixed rate loan, doesn't matter. I'm going to protect that as long as I can. The other thing I don't want to do is I don't want to have to hold a deal longer than I want to, because I have some massive prepayment penalty.
I just love this. I feel like, yes,
This is what we do.
I can't do this, but I can recognize that you guys do that. That's amazing. That's awesome.
Yeah,
a
so
lot of
when
guys
you-
are trapped. Like,
Well, you are trapped.
Grant Cardone stuff is trapped in these long-term 10-year things with some.
Yeah, well, I
rate
don't
cap.
think he has any interest in selling anyways.
No, I don't think he does either.
Yeah, he doesn't
He
care.
does.
But I learned this lesson when I was back in Cleveland, because I wanted to sell stuff. Because man, when you can sell something at a premium of Cleveland, you better jump on it. And if you miss it, too bad, so sad, right? So
Yeah.
CMBS loans, you can't do supplementals. You can assume it, but now you've got this big air ball between the loan amount and what you want to get for your property. So CMBS, let's see, you got to start to know and understand the loan products that are out there. So I try to manage I don't want to not be able to sell. That's why in the 2600 deal, I have a Fannie loan that I can do a supplemental. I can do an add-on loan so that the buyer doesn't have a huge down payment requirement, and I can still have flexibility now to sell it while I have fixed rate protection. And the other thing that I want to be able to do, that allows me to then sell whenever I want. That gives me the protection that I want. And Fannie is pretty easy to deal with, right? Other than the 30-day notice on the eviction stuff, it's pretty easy to deal with. So I know that is way deeper than, you asked that question, but there's so many things that we're trying to balance when we do debt. And it's going to depend on the project. What I won't do, I will never, ever, ever do naked variable rate financing. That's what I call it. I mean, imagine you saw what happened with rates. I mean, that there are guys that their interest expense has gone up 10 times. A $10,000 monthly interest expense turned into 120. I mean, you can't, you're done. I mean, there's no way you can live through that.
Yeah.
So really, really good question. Did I answer it for you?
This was terrific. Thank you so much. Just hearing
you're
how
welcome.
you guys manage all this is very helpful. Thank you.
You're welcome. Are you invested with us?
Not yet, but I'm excited. I send all these.
Yeah.
I think you guys are great. I'm just trying to get a sense of your organization, and I'm always impressed when I join these calls. So thank you so much.
Well, thank you. Thank you very much. Thank you. All right. Anybody else? Max, do we got anything else?
Hey, Ken, I'm going to jump in. It's
Hey,
Walt.
Walt, what's happening, my friend?
How you doing? So just I worked with Ken way back in his Deloitte days. Can you hear me okay?
Yes, sir. I'm going to spotlight you here, so hopefully you're ready
Ah,
for that.
I don't know if I'm ready.
There you go, brother. There you go.
My big head, right?
It's
So I
great
worked
to
with,
see you again.
yeah, it's good to see you too. So I worked with Ken back at Deloitte, and we did a project in Cleveland, and we purchased it. I think it was in 5, 6, and it was a rehab project. It was it 4?
I think it was 04. It's on my track record. Anybody wants to look, it's called Van Aken Crossing.
So that particular property, we purchased it right before a couple of years before the crash, and it was getting stabilized. And Ken was able to take that through all of that misery that we'd witnessed in the market. So in my day job, I represent commercial real estate clients across the country for a firm, and witnessing all of the properties going back and everything else. He was able to actually give us
Going back, meaning going back to the bank?
Correct.
Okay.
It did not. Whereas we were seeing properties go back to the bank.
Yeah.
Ken managed it through that, paid our preferred throughout, and we doubled our money. And that was an incredible victory for everybody that was in that fund. It was amazing.
Definitely.
So
Wow.
Yeah. Thank you, Walt, for saying that.
Yeah.
That was one of our tougher deals, man. There is no doubt about that.
and in Cleveland or Northeast Ohio, when you have a property, again, that's why he went down to Florida to do these deals. We didn't really have the the cap rates never really went down. It's hard to get the same return on investment that you can get in the Florida market or in the Southeast. So
Yeah, no, you're right. That is why we left. I mean, we made money in Cleveland, but man, it was hard. Nothing's ever easy, but we can do a lot better in Florida, and we have. So yeah, thank you, Walt, for that. And do you have any questions per se? You
I
just
don't.
you made my day, man. Thank you.
Yeah, I don't. I know that again, with the capital markets changing, I know the deal flow is sort of ground to a halt in many markets across the country in all types of properties. So we're curious. I'm curious on my day job, and then here when the dam is sort of going to break, like people are going to start trading properties, and how those opportunities will present themselves.
Now, Walt, I don't know when you came in, because once the screen goes up, I can't see everybody, but I will tell you, the deal flow is exploding right now.
Okay.
It is. I mean, we all of a sudden we can't keep up, and I attribute it to a couple of things. One, I think a lot of people were hoping that we would have inflation really come down and the recession fears really go up, so that Powell would be forced to decrease rates, start to lower rates. Well, I think what's happening is people are sensing, guess what? That's probably not going to happen, right? We don't see this recession hitting us in the face. We don't see the labor market really starting to struggle. And the Fed came out and said, well, we've probably got 2 more raises, right? So everybody's like, man, this is starting to suck. And the reason it sucks because they have these debt problems that are coming up in a year or a year and a half or 2 years that they have to solve. I mean, those rate caps are expiring, and their interest expense is about to go from 20 grand to 200, or some ridiculous thing. They know they've got a problem. So what I think they're trying to do is they're losing hope. They're changing their mind. They're like, I can't wait this out. I need to get ahead of this, get this thing sold while I can, because if I don't, I'm going to have a lot of problems. We just have somebody that we know. I can't give any more data than that. They went in, they did an awesome renovation project, and they sold it at cost. Why? Because that rate cap problem. So whoever bought it, man, got an awesome property. And then as rates over time, rates will come back down and insurance will come back down. They're going to make a killing.
Right. So another point, part of it public and part of it I'd like to talk to you offline is I have a client that sold, their $1 billion portfolio, and they are switching from an equity participant to, they're actually going to go to banks, and they're going to assist distressed borrowers and provide capital to them and work with those borrowers so they switch their strategy. So
But they're going to get a lot of people knocking on their doors, Walt. Because
right.
I'm telling you, the number of rate caps expiring is staggering. If you saw my little analysis, I just the question I asked them. This is going to go back to my discussion with, I don't know where she went now. With my discussion about, remember back in 2008, remember AIG being behind all the credit default swaps? And because everybody went to AIG at the same time, it destroyed AIG. I thought to myself a few months ago, I'm like, man, I'm seeing a rerun here, right? I'm seeing a parallel set of facts. Who is the counterparty to all these rate caps?
Right.
Because everybody's coming to them at once. I'm not the only guy that bought at 39 and ended up getting $350,000, $400,000 out of that rate cap. And that was a small loan. Just think about hundreds of these things. And how is that counterparty staying solvent? And I had a long conversation with the folks at Chatham, and they said, look, they just have massive balance sheets. And the reason they do is because they have been collecting on rate caps and not paying a dime for years and years and years and years. So they argue that they're still solvent, because I was worried about that. In case you were thinking about it, I thought I'd share that with you. But they claim they are solvent. So we are good.
Right. So part of the other strategy that this company is going to employ is, again, just they're aware that a lot of these banks are trying to raise capital because of all the capital that leaked out because of the quote unquote run on the banks that happened, and it continues to happen and flows into money markets and other places. So
yeah, you can leave your money sitting in your brokerage account in a money market. What, make 3 or 4?
4.5, yeah.
Yeah. Yep. Yeah. So why would you leave it? Why would you leave it sit somewhere else in a bank?
Right.
Yeah. So that's what's. Yeah, I think the banking system's going to be okay. The Fed has indicated, and they're going to backstop the banks. They're going to ensure any deposits, doesn't matter. The FDIC will. So I think we're safe there. That stopped all of that. But there is going to be some pain in that regional banking sector, and we can't have that sector go away because it's so important to the economy, right? At least that's my opinion, and that's what I hear a lot of people say. So I'm kind of parroting what they say, but cool. And I'll give you a call. We can talk offline about that. Whatever it is you want to talk about. Is that cool?
Yeah, just if you want to avail yourself of the opportunity, if I know you don't need it on any current deals, but who knows, as capital markets change, this could be another avenue to secure capital for deals.
Yeah, absolutely. I will absolutely talk to you about that. Cool. All right, sir. Tell Leslie I said hi.
Thank you. I will.
All right. Well, talk to you. Yolanda, what you got there, kiddo? I have
Hi,
to spotlight
Ken.
you. Hold on. I'm not super fast. There we go. What's up,
Oh,
kiddo?
okay, thank you. So I had to step away when you were talking about your underwriting class, which I was interested in.
Okay.
So did you say, is it like self-guided? And I saw you mention something about weekly calls or something
Yep.
like that.
Yep.
Can
Yeah.
you just
So
do an overview of that for me?
yeah. So here's what you're going to get. And Max, if you could, can you put the URL in the chat so that Yolanda, you can just click on it. It'll take you right out to the information page.
Yep.
But generally, it's me. If you got to like hearing my voice. It's all me. I'm going to take you through the whole underwriting process, the rent stack that you saw. And when I say detailed, I help you figure out every little piece on that P&L. You've known me long enough. You've seen me.
Yes.
I care about the detail. No BS.
Yeah.
We're not going to estimate. We're not going to guesstimate. We're going to go for the detail. We're going to figure it out, because then once you know what's going on, as you continue to progress in your career, you'll be in a position to do more estimating. But right now you've got to figure it out, right? You just do. So you're going to get the full underwriting instruction. You're going to get the rent stack, just the rent survey process, because if you don't understand where your income's coming from, you're toast, right? Because that's how we make money in this business. And then you're going to get the actual deal screener that we use, the actual spreadsheet. You're going to get the actual underwriting spreadsheet, which poor Max, I have put him through hell just with constant. It is far developed beyond what we've ever used before to give you on the spot guidance. You roll over a cell, it tells you what you're supposed to do there, all that kind of stuff. Right. So you get all of that. But here's what, that's cool, right? It's an online course and you go off and you go do your thing. But what I've learned is this can be complicated stuff, right? This can be confusing, especially, it's not for me because I'm a CPA and I've been doing this stuff forever. But for somebody who's not that numbers oriented, you're going to have questions. So I said, you know what? I can't do this. The whole reason we're doing this is because I want people like you to figure out how to do this, because when you do, it will change your life. I'm just telling you, it changed mine. I'm no longer a CPA because of it, right? It will change your life because you can make so much money in this business, but you can lose so much money if you don't know what you're doing. And that's why I'm doing this. So I want to be there on a weekly call, Thursdays at noon, so that, because you're going to have questions. You're going to go through, Ken, I don't understand this. What the heck are we thinking this? Tell me how to use this. And then Max is, of course, at your disposal. Not 100%. We won't give them away 100%, but we're here because I want you to understand how to do it. My goal is for when you're done, you'll underwrite a deal, then you'll underwrite another one, and then you'll underwrite another one. And all of a sudden you're like, man, I'm starting to figure this stuff out. And as you saw, the reason I took you through that 2600 exercise, imagine if I didn't do my homework on the rent stack properly up front before I told all my investors to come with me, right? And now things happen the way they did, and I didn't, and I was not able to get those new rents, I'd be screwed.
Mm-hmm.
I'd be totally screwed. I would not have new income to refinance the loan, to pay the interest expense. It would be really a big problem. And I see so many people going through this needlessly, because not only are they having a really stressful day because they made a mistake, and it's not that they don't want to know, they just don't know, right? That's why I want to help them. But all their investors are having a really bad day too. So you can see there's actually a little bit of self-service there, because it really does help this whole industry do it the right way, because I don't want anybody, especially your first deal, you can't lose money. And Walt has heard me say that. You cannot have your first deal lose money. If it does, you're done. You're not coming back. And you will have missed out on the opportunity to change your life. So.
Okay, so have you already started the calls and I think you've already started the calls.
Just jump right in. Yeah, no, they're not structured. They're Q&A calls.
Oh, okay.
Very similar to what we're doing now.
Mhm.
Warren's been on them. There's a couple other people here that have been on them.
Lisa,
Whatever it is see, here's the thing. I don't want to have the structured Thursday noon call. It says, Yolanda, we're not going to talk about that this week. I'm going to talk about that 3 weeks from now. You're like, dude, I need to answer now. I don't need it in 3 weeks. I want you to be able to ask that question right away.
Okay, good enough. Thank you.
Is that cool? You're welcome.
Thanks.
All right. Anything else? Anyone else? Max, we got anything else?
No more questions in the chat.
All right. Well, guys, once again, I hope I didn't go too deep into how we make the sausage. So some of you hopefully appreciate it. I always wrestle with how much to do here. I call this thing the real deal because I want full transparency. I want you to understand what goes on behind the curtain here, so that you can feel comfortable that, first of all, you can figure this stuff out. It's not rocket science. And you can see how we actually figure it out and what the benefits are. And you'll see how our portfolio is really doing. David, do you want to say something, my friend? No?
I do. Can you hear me and see me?
Yeah, absolutely.
I tried to put my hand up. I'm not, there we go. I'm not very good at this stuff.
I brought you up front.
Thank you. I met you down at the real estate seminar in Miami in March or April, whenever that was. Just a quick kind of a comment and a question all in one. We're shopping the Carolina markets, Alabama, Florida, Texas, seeing some real problems with the price per door in the Phoenix area. It's just crazy, $250, $350, $400 a door. It's crazy. I live in California. We're obviously not shopping that market. And me and my partner are from Roanoke, Virginia, and I'm from Omaha. So we also keep an eye on those markets just because we're familiar with them as well. What I want to ask you about, though, is this are you seeing this? We got a quote back from the insurance company And I did a tax estimator thing. The Hillsborough County has a little thing that they'll estimate the taxes based on your purchase price.
Mhm.
The insurance company quoted us. Now, these are properties, it's a small portfolio of 3 properties, older properties, I mean, like decades old, in the Hillsborough Bay Area, just a few blocks from the water. They were
Mhm.
coming back, at over $2,000 a door for insurance.
Yeah. You know why? What was the key phrase that you said there?
Water.
A few blocks from the water. That was the first thing. Second thing you said was it's decades old.
Yeah.
Okay, so the older the property, the less happy they are. Insurers in Florida care about roofs. If the roofs are new, if they're post-Andrew roofs, they got the straps on them and all that kind of stuff, and they're more comfortable than they are pre-Andrew. And the old, the closer you are to the water, right now especially, what's happened is insurers have pulled out of Florida.
Yes.
So what happens is you used to have this much capacity for insurance, not anymore. It's like this. Still, this many people want insurance. It's just this many people are willing to provide it. So that's why rates are going through the roof. Doesn't surprise me at all that you're over 2,000 a door. So what you have to do is stick to your discipline, right? That's what I talk about in these underwriting courses. It is what it is. You put if the insurance guy says it's 2,100 a door, it's 2,100 a door. You got to go with it.
He gave it. Yeah, he gave us a
thing.
range, like 2,100 to 27. So I just averaged everything out for the underwriting. But just so everyone that's listening to this knows, I mean, it changed the expenses over $100,000.
You know what I used to underwrite insurance in Florida? You ready for this?
Yeah. 400
a door.
Yeah.
Our landings at Crystal Cove, we are currently at $1,653 a door. And we are, you saw, I just got a big discount on my GL.
Yes.
I am psyched about that. I am excited about that. Our problems in Daytona within 5 miles, we're over $2,000 a door. It just is what it is. Now, here's what I think. I don't want you to underwrite this, but this is what I think. What happens, insurance goes in cycles. If you've been in this business long enough, prices go way up. People are making a lot of money. Assuming we don't have we get a year or so, we get a little bit of a break from hurricanes. New people come into the market because it's massively profitable. Then they start beating each other up for price because the capacity goes back up. Then prices go down. Then hurricanes come. It's a cycle. The hurricanes come, and it's money. Then they get mad. Then they leave. Prices go back up. It's literally that. So I feel like we're pretty close to the top, right? I don't know that we're at the top. I'm not an insurance expert, but if I underwrite at 2,100 a door, and I've got a 6 cap because of where interest rates are, and I've got, I underwrite increased taxes like you should. Well, I feel like I might get some relief in the future. I'm still going to look for upside in the rents, but I might actually have some wind in my back because those insurance rates might come down. That's a good thing, right? In my mind. Warren Buffett said on CNBC about 3 weeks ago, yeah, it's starting to look very attractive, he says, because, Warren might own a few insurance companies, right?
Yeah.
He might have his finger on that pulse. So you see what happens. And I thought, man, he's doing it. He's doing exactly what the insurance companies do because now it's attractive.
Right. Okay.
Those are good questions. I would encourage you to focus in on fewer markets so that you really get focused on a market and really understand it. If you can, because otherwise you start to try to figure out too many markets all at once, and it's going to be hard to keep up with.
And I am, and we're trying to. I think we need to key in on one that looks. I mean, what markets do you like right now, if I may?
I like most places in Florida.
Okay.
Well, because I'm in all those places. I mean, we've got a couple thousand units throughout Florida.
Okay.
So I'm all over the place. Daytona, Tallahassee. I've been in Jacksonville, Bradenton. All over Tampa, St. Pete, Winter Haven, Orlando. See, I've been in all these markets, so I'm comfortable with them. We're now looking to other markets because I just need deal flow, and I just do, right? So we're looking at the Carolinas, just like a lot of people are. I want to stay in the growth markets because I want demand for my product to exceed the supply of my product.
Right.
Because when that happens, that's not a bad thing.
Right. Right.
So that's what my key is.
Okay, all right, very good.
That help you?
Yeah, absolutely. And I copied your QR code yesterday. We're gonna take a look at that package, because any material we can get that facilitates and makes it, things making sense. I mean,
Yeah.
just even like the cap rate. I mean, like, it's such an arbitrary number. It really is.
Well, it's actually not. I can take you through that. Cap
Okay.
rates are actually, here's how I want you to think of cap rates. You and I are going to do a deal together, right?
Okay.
Let's pretend like you're the lender, and you're going to give me 2/3 of the money, and I'm going to put in 1/3. But each one of us has an income requirement, right? You want something for your money, right?
Yes.
It's fair, and I want something for my money. So whatever you want, you're gonna what you need for a return on your money is going to be dependent on your cost of funds and how much risk you think is in that. So you're going to say, I want 6%. And I'm going to say, you know what? I'm an investor. I agree with you. I'm cool with 6%. If both of us are cool with 6%, that property, that means the cap rate can be 6%. And
Right.
both of us are satisfied. That's how that. So now if the cap rate is 6%, we know that you're going to be happy and I'm going to be happy. But if somebody's trying to sell you something and the NOI is actually makes it a 5 cap, guess what? You're the lender. You're going to get paid first. So who gets screwed? Me.
Right.
You're
Yes.
going to take your 6% and I'm going to give you part of my money so that you can be happy because the property doesn't throw off enough to make us both happy. That's literally, if you think of cap rates that way, it'll always make sense. And that's why interest rates drive cap rates. Now, here's what happens in Florida. It will aggravate you because people see the growth in Florida. So they're willing to say, you know what? I'll let you have your 6%, Mr. Lender. I'll go for 2% because I know I'm going to increase rents so much. And then the growth is going to let me earn in the long run enough that I'm going to be happy. That's how cap rates get below. That's called negative leverage. I don't like it, but that's how people justify negative leverage in their mind. Buying at a 5 cap when their interest rates are actually 6. Does that make sense?
Yes. Incidentally, we got a soft quote on the said properties that I was talking about from Chase terms, and so it's they underwrote it at a 7.03 cap rate.
It's because they're small properties and they're old.
Yeah.
And you're not in that market, right? What's total number of units?
49.
Yeah, see, so it's a small property. You're not in the market yet, I don't think, based on what you've told me. And it's an older deal, and it's gonna be, it could be 7. That wouldn't shock me.
Okay.
But they're not the only. I would encourage you to use a mortgage broker.
Yes.
Make sure you use a broker.
I've heard you say that before on the Wednesday calls, and I made note of it. So yes, thank you.
Yeah, because they know, like, you might be good for an SBL. See, what's making it a challenge for you is you got 3 separate properties.
Yes.
Right. You got to file 3 mortgages. You got to underwrite them separately, and it just makes it a little harder. Doesn't mean you can't do it. A mortgage broker might find you a bank solution. We did Palms at Daytona with Customers Bank. Got a screaming rate. We got 385. And it was when everybody else was getting 6. Right. I don't know why. They held the line on the rate. But my point is, those brokers they know what's out there better than you would. Chase doesn't do a lot of that kind of stuff.
It's my understanding they just started a multifamily division within them.
Yeah.
So okay.
You don't want to be that guy. You want the mortgage broker that has all the relationships.
Yes. Okay.
Who's the broker? Is it the sale broker?
Oh gosh.
What firm do you remember?
It's Christopher. Italian last name.
Yeah, well, I was thinking the firm might have their own underwriting, their own mortgage arm.
Oh, I'm not sure. I'm not sure.
They might. They might.
Yeah. I should have had this in front of me, but
First.
It's oh my gosh. Oh, I'm sorry. I can't find it.
Yeah,
right
no
now.
worries. No worries.
And I don't want to take up everyone's time.
Yeah, no, I'm thrilled that you're here. And look, here's what I'll tell you. That course, here's what's important to know about that course. I'm going to tell you how, and I'm going to tell you why. Every single thing that I'm trying to teach, I tell you the how and the why. I'm gonna tell you how to figure out taxes. I'm gonna tell you how to get every one of those numbers. I'm gonna show you how to do a rent survey. If you want to learn that, the course is right. If you already know how to do all this stuff, of course, probably isn't worth it for you. But I would definitely encourage you to look at that, because I feel like nobody goes into this level of detail. What was the last thing I was going to tell you? Trust your gut. Stay disciplined on your underwriting. All right.
Yes, absolutely.
And you'll stay out of trouble.
Yes, I mean, I'm in this to, like Warren Buffett says, don't lose money. And I want to mitigate as much risk as possible.
Yeah.
And as you said, don't fail on your first one. So
yeah. And you're on the Wednesdays calls, pitch them.
Yes. Okay.
Don't be afraid to pitch them. It's okay.
All right, Ken. Thank you so much.
Thank you so much. All right. Nice talking to you.
You too.
All right, Max, anything else?
No more questions in the chat.
All right. Barbara, I spoke to Atlanta. They like secondary markets in North Carolina. They're hesitant with Atlanta, Nashville, Mount. Okay. Yeah. Yep. So they're probably parroting what Fannie and Freddie say. I would suspect, Barbara, but yeah, that's good stuff to know. All right, guys, it is 8:30. Wow. I have kept you a long time. Thank you so much for coming, for listening, and hopefully at least it'll help a little bit. And if there's anything we can do for you, please let us know. Okay. All right, guys, have a good one. See ya.
Night, Ken.
Good night, Mr. Walt.